When I first got into real estate, I thought forming an LLC was the finish line. I remember filing the paperwork, getting that approval letter, and thinking, that's it, I'm protected now, I'm official. And honestly, that confidence almost cost me a lot of money. Because here's the truth no one really explains when you're starting out. An LLC is powerful, but only if you actually use it the right way. I see new investors make the same mistakes over and over again, and I've made a few of them myself. So today I want to walk you through this from my own perspective, not like a checklist or a lecture, but like a real conversation about what actually matters once you form that LLC. The first thing I learned the hard way is that getting an EIN doesn't mean anything if you don't actually use it. That EIN is basically your business's identity with the Internal Revenue Service. I've seen people proudly tell me they have an LLC, but then every dollar of rent is still going into their personal checking account, and every repair is going on their personal credit card. That's not a business. That's a lawsuit waiting to happen. When you don't separate your money, you're blurring the line between you and the LLC. And if that line disappears, so does your protection. I've seen investors get denied financing, disaster loans, even simple business credit. Not because they weren't making money, but because on paper their business looked like a mess. Once I started running all income and expenses through a business account tied to my EIN, everything changed. The paper trail became clean, the banks took me seriously, and my risk dropped overnight. Another big wake-up moment for me was understanding how my income was actually being taxed. Early on, I just assumed money was money. If the LLC made it, I paid tax on it and moved on. That mindset is expensive. The type of income your LLC earns completely changes how much you keep. When I was doing active work, managing deals, and providing services, that income got hit with self-employment tax. And at first, it didn't feel too bad. But once the numbers grew, that extra tax started eating into profits fast. That's when I realized why experienced investors plan ahead, sometimes even changing how the LLC is taxed once the income reaches a certain level. On the flip side, when I shifted more into long-term rentals, the tax treatment was very different. That passive income didn't get hammered the same way, and suddenly the structure of the LLC mattered more than ever. What surprised me most was how many business owners don't even know what tax forms apply to their own company. I used to think that was the accountant's job, and that mindset is dangerous. If you don't understand how your business reports income, how profits flow to your personal return, or how contractors are documented, you're operating blind. I'm not saying you need to become a CPA, but you should never be in a position where someone files something in your name and you have no idea what it does. Now let me talk about a mistake that hits real estate investors especially hard, because I see this one constantly. Buying property before forming the LLC, I get it. You find a great deal, emotions kick in, and you just want to close. I've had investors come to me after the purchase asking if they should move the property into an LLC. That's when the problems start. When you buy in your personal name and try to transfer later, you can trigger loan issues, taxes, and legal complications you never planned for. I learned early that if a property is meant to be an investment, it should be bought the right way from day one. When the LLC owns it from the start, everything is cleaner. Ownership, liability, record keeping, even privacy. It's one of those decisions that seems small at the moment but protects you for years. Another subtle mistake I made early on was paying for business expenses personally and never properly reimbursing myself at first. It felt harmless. I pay for a repair, a filing fee, or a service with my own card, and tell myself I'd figure it out later, but later never came. And that creates tax issues and accounting chaos. There's a right way to handle those situations, and it requires documentation and intention. When done correctly, you get your money back without creating extra taxable income, and you keep the LLC clean. When done wrong, it just looks like more commingling, which brings us right back to that liability problem no one wants. As I grew, I also realized how many investors ignore business credit entirely. They rely on personal credit cards, personal loans, personal guarantees for everything that works until it doesn't. A strong LLC with real business credit opens doors. Better financing, better terms, and the ability to scale without putting everything in your own name. That only happens when the foundation is built correctly from the start. And finally, one of the most expensive mistakes I see is skipping professional guidance because you think you've figured it out from videos and posts. I've been there. But real estate and taxes are nuanced. One small decision can have ripple effects for years. A short conversation with the right professional early on can save you more money than your first deal makes. So here's my real takeaway from all of this. Forming an LLC is not the strategy. It's the tool. The strategy is how you use it. When you respect the structure, keep things separate, understand your income, and plan before you buy, the LLC does exactly what it's supposed to do. It protects you, it saves you money, and it gives you room to grow. If you're serious about building wealth through real estate, don't rush this part. Do it once, do it right, and let your business work for you instead of against you. That's it for today. I'll see you in the next one.